I think right now that the Fed has exactly one tool, and that's QE. And I don't think that they want to admit it. They have all these fancy credit facilities that have been set up, but they really haven't been tapped. And what they've done is put a floor underneath the corporate credit markets, and that is indeed very important. But the reason that you're seeing from Powell onto every Fed official down the line, practically begging in public for there to be stimulus spending, is that the Fed is looking for product. They're looking for something to buy because they're already buying more mortgages than are being originated on a net basis, which is saying something because mortgage originations have been running at record levels in 2020. But they're looking for more product to buy. They're looking for more treasury issuance so that they can monetize that debt, because the only transmission mechanism they know that works is the one that goes from QE and filters back into the stock market. If you look at the fine print of the contract with BlackRock, equities are already written into what the business that the Fed can conduct with BlackRock. So that is absolutely a possibility. And again, we have to remember that Powell drew a line underneath the stock market when he came out and said, you know what, we're going to buy junk bonds, which, you know, at last check, it's been a while since I've been in business school, junk bonds are riskier than stocks. So what investors need to realize is he would actually be stepping in on the risk spectrum to go the way of Switzerland and Japan and buy directly equities. Every Fed president comes with their briefing in hand, and you go around the table and everybody has their deliberations. The arguments are made. It's extensive. It takes days, plural. There are presentations. There are models that are shown. There are slideshows. It's very involved. But again, if you're at the zero bound, and the Fed has been at the zero bound for much of the past decade, if you're at the zero bound, the only discussion that you're really having is how do we get more product? How do we get more QE? And whether we like to think about it or not, and this really gets under the skin of the Federal Reserve District presidents, the Federal Reserve is really two people. And nobody wants to hear this, but it is, nobody inside the Fed wants to hear it. Rephrase. But the vice chairman of the Federal Open Market Committee is the president of the New York Fed. This person has a permanent vote on the Federal Open Market Committee, but again, vice chairman of the FOMC. So if Jay Powell gets a stomach flu, this person is the second in command running the FOMC. So the people who are the decision makers are the chairman of the Federal Reserve, the chair, of the Federal Reserve Board, and the head of the New York Fed. They are the power players. And where they think policy should go is where it eventually does go. You can have dissent, but eventually, again, you have a two-day meeting and there is a lot of pomp, circumstance, and presentations, but policy is going in the direction of the two people effectively running the Fed, the two power players.
You're working in the private sector now doing market research. What do you look at? When you get a copy of the Federal Reserve meetings, what are the first things that you're looking out for in that copy?
Well, I don't follow the minutes as much. I do come through the minutes and look for the prevalence of words, keywords. For example, in the last minutes, the word layoff was everywhere. So it was apparent that the Fed was aware that the unemployment situation was not improving and that layoffs are moving into the white collar sector, which is they're the people who spend money. What I do follow as chief strategist at Quill Intelligence is bond market volatility. If you want to know whether or not the confidence game is successful at the Fed, don't follow the VIX. Follow the VIX's twin sister, bond market volatility, the MOVE index, MOVE. As long as it remains near record historic lows, then the Fed is succeeding in keeping credit risk at bay. And that is the sole goal for the Federal Reserve System, because the credit markets dictate what happens in every other risky asset class. I don't know what's going to happen next week, much less in the next 2 years. And Jay Powell himself was never a fan of the dot plot. But again, it is something the media spent weeks deliberating over the change implicit in going from asymmetric or symmetric inflation policy to average inflation. There was no change of substance about it. In that same way, You'll have an army of people on Wall Street, buy side, sell side, all the economist community going over the dot plot as if it's a Ouija board and it's going to tell them anything, when again, they don't know what's going to happen in the coming week, quarter, much less to say 2 years from now. What the dot plot did tell you this last time, however, is that even though the Fed is saying it's concerned about inflation overheating, if you look out to 2023 and their own projections, the core PCE only rises to 1.7%. Very importantly, for the credit cycle, we are at the very beginning of the household credit cycle. We've seen something extraordinary. We have FHA mortgage delinquencies at 17.5%. At the peak of the housing bust, they were at 14.4%. And yet, you've got runaway home prices. You've got home prices rising at 12% year over year because of the CARES Act. Never in the history of the U.S. economy have you seen fiscal stimulus come in and provide 12 months of forbearance, wherein households don't have to make a mortgage payment for 12 months and they get tacked onto the end of the mortgage. You've got a moratorium on rental evictions. You have car lenders who've given accommodations for 6 months now. You have even credit cards that have given accommodations. So the reason that we've seen, even though they're running at the highest level since 2009, the reason that we've seen bankruptcies not skyrocket, and the reason we've seen defaults not skyrocket, is because the household credit cycle has been kept in check. So until you have the household buckle, you're not going to have the feed-through mechanism into the corporate credit cycle. And that's exactly what Jay Powell is super focused on, because of the permanent damage that can be done if the walking wounded, the zombie corporations, the corporations that don't have enough cash flow to cover their interest expense, what happens if they actually go from being kept on life support by the capital markets, being forced open by the Fed, quantitative easing? What happens if these companies actually go and file Chapter 11? We haven't seen how bad it can get.